Over the past few years, I've come to spend my time talking a lot about the concept of bullshift, where the financial services industry shifts people's attention to make them feel more bullish. There's a lot of misinformation and bullshift in the financial services industry, and refuting anything that is baselessly believed to be true is a daunting task at the best of times. Many people within the industry will brush that concern aside and insist that things are fine and that there's nothing to be alarmed about. But that's because the industry mindset, while subtle, is nearly all-consuming and pervasive once you've been in it for a while. It's difficult to be concerned about a problem if you're oblivious to it. So, for example, the belief many advisors have in active management is one of the great bits of societal misinformation in the world today. What is said by people in business is often presumptive in nature. People within the industry, and especially advisors, are eager to conform with their industry's mindset and culture. They frequently say bullshit sorts of things as if they were true, while being simultaneously unaware of their own biases and false beliefs. These misguided beliefs are broadly supported and reinforced through an industry that has a machismo approach to stock picking as a reliable value proposition. The industry makes more money when people trade, so it encourages trading by being bullish about the prospects of success. In fact, all trades are a zero-sum proposition. The extent to which one trader benefits is equal to the extent to which the counterparty in that trade falls behind. In aggregate, the traders are on opposite sides of the same trade, so that taken together, the pair is neither better off nor worse off than a passive investor who might simply hold the shares. But that's before costs and fees are considered. Everyone knows that if they visit a casino, the odds of winning are less than 50-50 and structured so that over time, the house is virtually guaranteed to win. Well, trading is similar, but nonetheless a bit different. When you trade, the odds are 50-50 and there's always an equal-sized winner and loser in the transaction. The difference is that those transactions cost money, and the more people play a game that has a 50-50 proposition of generating a favorable outcome, the more money the industry makes as a direct result of their playing. The cost of playing is not free. Depending on your methodology, investors may pay for research, they may pay for trade execution, for both the buy and the sell, and they may trigger tax liabilities that they otherwise might have deferred. Instead of having a 49% chance of winning, as might be the case in a casino, there's a 50% chance of winning, but you'll be paying a 1% fee in order to play the game. Different paths, but in the end, we get to the same place. The house wins. Most people have an optimistic view toward capital market performance that's rooted in markets going up over a very prolonged time horizon. It may be that optimism bias threatens your finances. Of course, the appropriateness of an optimistic viewpoint can be held into question whether one trades stocks actively or not. Often, markets tumble severely and stay depressed for long periods, and no trading philosophy can overcome the hardship investors are likely to endure. The finance industry has a vested interest in shifting your attention and keeping clients feeling bullish because bullishness leads to more fee-generating transactions and asset gathering. With apologies to Martin Scorsese, it might be said that there have been a few too many raging bulls in personal finance today. Jake LaMotta was the original raging bull, and with the use of constant stalking, brawling, and inside fighting, he developed a reputation for being a bully, which earned him his nickname. As with the boxer, commentators might marvel at the finance industry's resilience because big finance has taken a number of body blows that would knock out a lesser industry. Given the billions of dollars at stake, it should come as no surprise that the industry keeps on finding ways to stay in the fight. The industry stays on its feet and keeps its critics off balance by bullying them. According to Wikipedia, bullying is the use of force, coercion, hurtful teasing, or threats to abuse, aggressively dominate, or intimidate. The behavior is often repeated and habitual. One essential prerequisite is the perception by the bully or by others of an imbalance of physical or social power. We have a political bully south of the border. The most obvious tool used by the industry to bully internal critics is the rule that says, among other things, correspondence to the public must not be false or misleading. That's because member firms, which is to say broker-dealers, are the sole interpreters and enforcers of the self-regulatory industry's procedures and code of conduct. If a registrant has a dispute with an employer regarding the interpretation or the enforcement of a rule, there's no one to appeal to. This is a lot like the autocratic situation south of the border. When people at the top are allowed to be the sole interpreters of what is and isn't allowed and what is and isn't true, people are at risk. Evidence, no matter how credible and voluminous, is of no consequence to bullies. If an advisor is dissatisfied with his firm's interpretation of the rule, his only recourse is to leave the firm in the hopes of finding another employer which is more open-minded. Now, obviously, if the industry closes ranks, evidence-based advisors who speak out against corporate interests may be subjected to significant career risk, ostracization, and even blackballing. Speak the truth to power to alert the public of the inherent risk associated with the industry's mindset, and you get into trouble. What investors need is an advisor who will stand up to the industry to fight for their interests.